Welcome to the Deep Dive. We're here to give you that shortcut to getting really informed, cutting through the clutter of complex reports. We do the heavy lifting, pulling out the key insights so you can quickly get up to speed. And today we are diving into HP Inc.'s latest annual report for 2024. Specifically, that's the Form 10-K.
Right, the big one. It's their detailed report card filed with the SEC.
Our mission really is to give you a clear snapshot of HP right now. We're talking their business landscape, financials, growth plans, shareholder value stuff, and the big challenges they're facing.
Think of it like the highlights reel from thousands of pages. We want you to grasp the pulse of this global tech leader.
So we'll unpack their main business areas, point out some, well, maybe surprising financial shifts, see how they're trying to reward shareholders, and look ahead.
You should walk away with a solid understanding without getting lost in the weeds.
Okay, let's jump in. So HP Inc., massive global tech company, operates in, what, over 170 countries?
Yeah, huge footprint.
Known for PCs, printers, services, subscriptions, all that hybrid work tech we're all using now.
And that global scale is key, right? It affects their supply chain, how they compete in different regions, everything. Their business mainly breaks down into personal systems and printing.
And there's a smaller bit for corporate investments, too.
Exactly. That's where they're planting seeds for future stuff.
Got it. Okay, let's tackle personal systems first. This is the laptops, desktops, accessories, services for consumers, for businesses.
Right. Think gaming lines like Omen, Invictus, or Spectre, Envy, Pavilion, Chromebooks, all the PCs, basically.
So how do they do in fiscal 24 compared to 23?
Well, personal systems net revenue actually nudged up a little bit, about 1.4%.
Okay.
What's interesting is why. It wasn't higher prices. It was mostly because they shipped more units. PC unit volume was up over 3%, mainly driven by the commercial side, businesses buying PCs.
So more units sold.
Yeah.
You said not higher prices.
Correct. Average selling prices, or ASPs, actually dipped by about 1.4%.
Why is that?
It points to a really competitive market. They had to adjust pricing, maybe due to competitor actions or just shifts in what kinds of products people were buying, maybe lower-end models.
And the consumer side specifically.
That actually saw revenue decrease by about 2.4%. The report mentions demand softness, particularly in China. So it's a bit of a mixed bag within personal systems.
Selling more units overall, but getting slightly less for each one on average. That is a tricky balance.
It really is. And they're definitely pushing hard on AI integration. We're seeing new AI PCs, workstations built for local AI processing.
Meaning the AI stuff happens on the device itself. Faster, more secure.
Potentially, yeah. That seems to be the angle. Plus, intelligent features in printing. AI is clearly a big strategic bet for them.
Makes sense. Everyone's talking AI PCs now. What about the profitability of this segment, the earnings?
Earnings from operations as a percentage of net revenue, so their operating margin, it actually ticked up slightly, just 0.1 percentage points.
That's tiny.
Better gross margin helped. Lower supply chain costs, which we've heard from others too, and savings from their big restructuring program, the Future Ready Plan.
Okay, so cost savings helped offset maybe weaker pricing.
Right. But those gains were partly chewed up by higher operating expenses, things like litigation costs and investments in how they sell and market products.
Got it. Okay, let's switch over to the other big piece, printing.
Yeah, the other cornerstone. This is everything from your home inkjet printer to big office machines, industrial graphics, 3D printing, and all the supplies, ink, toner.
And personalization, too, like custom printing stuff.
Yeah, they're involved in that for commercial and industrial markets. It's a pretty broad area.
And how's it structured? You mentioned supplies separately.
They break it down into commercial printing and consumer printing hardware and services, excluding supplies, and then a dedicated supplies segment. That's the ink, the laser cartridges, industrial stuff, the recurring revenue part.
Ah, the classic razor and blades model, almost. Sell the printer, keep selling the ink.
Sort of, yeah. And that supplies part is probably more crucial than ever because the rest of the printing segment really faced some headwinds in fiscal 24.
Oh, how's that?
The report talks about industry-wide demand softness, just less printing happening overall, and really fierce price competition.
From who?
Especially Japanese competitors who apparently benefited from favorable currency exchange rates, making their products cheaper.
Ouch. So what did that do to HP's numbers?
Both commercial printing and consumer printing revenues were down significantly. Commercial by almost 8%, consumer by over 9%. Unit volumes were down too.
Wow, that's quite a drop compared to personal systems.
It is. And average selling prices for the printers themselves also declined because of that competitive heat, even though they might have sold a slightly better mix of products sometimes.
So what's the bigger picture here? Just competition or is something more fundamental changing?
It's definitely both. The competition is intense, no doubt. But there's also that huge underlying trend, digitization. More stuff is digital, hybrid work means less office printing. The fundamental demand for traditional printing is, well, shrinking.
A secular decline, they call it.
Exactly. It forces HP to innovate in areas like industrial or 3D printing, or find ways to boost that supplies revenue.
But despite those revenue drops, how did printing's profitability hold up?
Interestingly, just like personal systems, printing's operating margin also edged up slightly by that same 0.1 percentage points.
Again, how?
Same reasons, basically. Favorable product mix within supplies, perhaps, and those future-ready cost savings kicking in. It shows their cost control is working, even when revenue is under pressure.
That's impressive, protecting margins like that.
Mm-hmm.
Okay, and that third segment, corporate investments.
Right. This is their incubator, essentially. Business incubation, investment projects, especially around digital enablement. Think R&D for totally new ideas.
So probably not profitable yet.
No. It reported an operating loss in fiscal 24, which you'd expect for these kinds of future-focused bets. It's the cost of trying to find the next big thing.
Okay, so with personal systems having mixed results and printing facing declines, what's HP's grand plan? You mentioned Future Ready.
Yes, the Future Ready plan is their big strategic initiative. It's about optimizing their cost structure, yes, but also making targeted long-term investments and changing how they go to market.
Investing where, specifically?
They're focusing on hybrid work systems, gaming, specific workforce solutions, consumer subscriptions like Instant Ink plus industrial graphics, and 3D printing and personalization.
So areas they think will grow faster and have better margins down the line.
Exactly. It's a deliberate shift towards things like recurring revenue and these adjacent growth markets.
And the cost optimization part, is it just trimming expenses?
It's more structural. They're aiming for savings through better operational efficiency, more digital transformation internally, and optimizing their portfolio, maybe getting rid of less profitable lines.
Does that involve job cuts?
Yes, the plan includes expected workforce reductions. The report mentions approximately 7,000 employees by the end of fiscal year 2025. It's a significant restructuring.
That's substantial. Okay, shifting gears a bit. No big company operates without risks. What stood out to you in the 10K regarding challenges?
Oh, there's a whole section, as you'd expect. Intense competition is just a given across everything they do. It means constant pressure on pricing and innovation.
Makes sense. What else?
Supply chain vulnerabilities are huge. They rely heavily on third-party suppliers.
Right, component shortages, manufacturing hiccups.
Exactly. And the report notes the geographic concentration of some facilities adds risk, too, thinking about geopolitical events or natural disasters.
It's the big one for hardware companies. And the printing decline we talked about.
That's listed too, the impact of digitization. It's a long-term secular challenge.
What about newer risks, like AI?
Interestingly, AI is listed as both an opportunity and a risk. While they're investing heavily, they acknowledge competitive risks if others do AI better, reputational risks if their AI makes mistakes, liability risks.
Huh. And even the risk that AI could cannibalize their traditional products.
Yeah, potentially. If AI tools reduce the need for certain hardware or print tasks, it's fascinating. Cybersecurity is another major one, of course.
How is this?
High exposure to threats, including, they specifically mention, AI-enabled attacks. They state they have a comprehensive program and board oversight, but the risk of a material breach is always there.
So AI is a double-edged sword. And what about risks related to that restructuring plan?
Well, restructurings themselves are risky. They're costly, disruptive, and there's always the danger of losing key talent during the upheaval. Plus, ongoing legal issues like litigation always consume time and money, even if some recent patent disputes were settled.
Lots to navigate. Okay, let's look at the overall financial picture. How did HP do in total for fiscal 24?
Total net revenue was basically flat compared to the year before, down just 0.3%. U.S. revenue was flat. International down slightly.
Flat revenue, but what about profit margins? You said margins improved in the segments.
Yes, and that showed up overall. HP's consolidated gross margin increased by more 0.7 percentage points in fiscal 24, again driven by lower supply chain costs and those future-ready savings. Pretty good cost control.
But what about the bottom line? net earnings?
Net earnings were actually down. They came in at about $2.8 billion for FY24, compared to roughly $3.3 billion in FY23.
So even with better gross margins, the net profit fell. Why?
Likely due to those higher operating expenses we mentioned earlier, litigation, go-to-market investments, maybe restructuring costs hitting the bottom line.
Okay. And their taxes. Anything notable there?
Their effective tax rate was around 15.4%, which is below the standard U.S. corporate rate. That's often due to earnings in countries with lower taxes. They do note that new global minimum tax rules, BEPS Pillar 2, start applying in fiscal 25, but they don't expect a material impact initially.
Let's talk cash flow. Crucial metric. How much cash are they actually generating?
Good news there. Cash flow from operations increased by about $0.2 billion in FY24 compared to FY23, mostly due to better working capital management. This operating cash flow is still their main source of liquidity.
So generating more cash from the day-to-day business, where did that cash go?
Well, they used cash in investing activities about $646 million, mostly buying property, plant, and equipment.
Reinvesting in the business.
Right. And they also use more cash in financing activities, up by $0.2 billion. The main driver there was increased share repurchases.
Yeah, returning cash to shareholders. We'll get back to that.
Yeah.
Let's quickly touch on the balance sheet. What did it look like at the end of October 2024?
Pretty solid. They had over $3.2 billion in cash. Inventory was around $7.7 billion. Accounts receivable, $5.1 billion. Their current assets were roughly double their current liabilities.
Meaning they can cover their short-term obligations pretty easily.
Seems so, yeah. One interesting note on debt. Short-term debt increased by $1.2 billion, but long-term debt decreased by $1.0 billion, mostly because some long-term debt got reclassified as short-term as it neared maturity.
Okay, standard stuff. But you mentioned something earlier about internal controls.
Yes, this is important. The report discloses an identified material weakness in internal control over financial reporting as of the end of FY24.
Material weakness, that sounds serious. What does it relate to?
It's about IT general controls for certain key financial applications. Things like managing user access, controlling changes to the systems, monitoring automated job schedules, basically controls around the IT systems that handle financial data.
Yeah, and what's the implication?
While they state it hasn't led to a material misstatement yet, a material weakness means there's a reasonable possibility that it could. It signals a significant flaw in their control environment. Management says they're actively working to fix it.
Is this new?
It was actually identified in 2023 as well, so it's an ongoing issue they are still remediating. Definitely something to watch.
Okay, definitely. Now, back to shareholder value. You said they increased share buybacks.
Yes, significantly. In fiscal year 2024, HP returned a total of $3.2 billion to shareholders.
Wow. How did that break down?
About $2.1 billion was spent repurchasing shares. They bought back almost 63 million shares, and another $1.1 billion was paid out in cash dividends.
That's a substantial return. Any plans to continue?
It looks like it. The board upped the total share repurchase authorization to $10 billion back in August 2024. As of the end of the fiscal year, they still had about $9.3 billion left under that authorization.
So plenty of room for more buybacks if they choose.
Seems so. They have a history of regular dividends, too, although that's always up to the board, depending on performance, cash flow, and other priorities.
Of course. And investors should remember, buybacks aren't guaranteed, right?
Exactly. They don't have to complete the full authorization, and things like managing their debt levels to maintain credit ratings could also impact how much cash is available for buybacks or dividends.
Okay, so putting it all together, assessing HP moving forward, what's the overall outlook? Do they feel confident?
Based on the report, yes. They express confidence that their current cash position, operating cash flow, access to borrowing, commercial paper, credit lines, all that is sufficient to cover their needs for the foreseeable future. Operations, capital spending, debt payments, pensions, buybacks, dividends, they believe they have the liquidity.
That's a strong foundation, especially with the big changes they're making.
Absolutely. And they seem fully committed to that future-ready plan, focusing investment on AI, hybrid systems, 3D printing, while driving those efficiencies and cost savings. The shift towards being an experience-led organization, integrating software deeper with hardware, seems key to their vision.
More than just selling boxes, selling solutions.
That seems to be the goal.
But the challenges haven't disappeared, right?
Yeah. No, not at all. They acknowledge ongoing market uncertainty, businesses being cautious with IT spending, that continued decline in traditional printing. And the competitive landscape remains incredibly intense. Plus, those supply chain complexities aren't going away overnight. It requires really nimble management.
It really underscores how even giants like HP have to constantly adapt. What about their people? You mentioned job cuts, but they have a huge workforce.
Around 58,000 employees in nearly 60 countries. The report stresses their focus on attracting and retaining talent, engaging work, learning opportunities, competitive pay, wellness programs. They cite high participation and positive results in their employee engagement surveys.
So trying to manage the human side of the transformation too, and ESG.
Yes, they emphasize their commitment to environmental, social, and governance goals, climate, human rights, digital equity. Though they also note that the standards for reporting on ESG are still evolving, which presents its own challenge.
So we really dug into HP's 2024 report. It paints a picture of a company in major transformation mode, right? Trying to balance that huge legacy hardware business with big bets on future trends like AI, hybrid work, recurring revenues.
It's a fascinating balancing act, and it leads to a key question, I think. You have HP with its deep pockets and this clear strategic vision to become more experience-led, but then you have this acknowledged material weakness in their internal financial controls. How might that underlying issue impact their ability to execute these ambitious shifts, especially into complex areas like new software models and AI integration?
That's a really interesting point. It's not just about having the money or the plan, but having the solid operational foundation to pull it off reliably.
Precisely.
So what does this all mean for you listening? It shows that even the biggest, most established tech companies are constantly reinventing themselves. Think about how these trends, AI, hybrid work, the shift to services, might reshape the technology you use every day, and how these giants are racing to keep up.